thanks so much for having me. It's really a great pleasure to be here in sunny California, even though we had warmer weather in Canada than here. So, the scenery is much nicer here. This is trying to work with Christine Pallur from UC Berkeley, and we're looking at systemic fragility in these decentralized markets. So we know a lot that contagion exists in the traditional financial system, in the banking system. If you look at recent bailouts that have happened in SVB or other banks, this is often cited as an important reason, but we don't really know a lot about how does this work in DeFi markets. And why is this interesting? So in DeFi markets, we have a setting where capital can move freely. There's no constraints. Money can be injected and moved very quickly as compared to some of the other markets where there's certain trading hours and things like that. So we have some innovations like flash loans that I'll talk about later that allow you to overcome capital constraints for arbitrage and other activities. So anybody can do anything pretty much. There's no capital constraint. We see everything in these systems. So we see exactly what do people trade, what positions do they have. So the data quality is there that's not there in traditional financial markets. And finally, there's no regulators, no lender of last resort. So we can really see compare this to the traditional financial system and see what would happen if there was no Fed that would intervene or no government that would bail out the troubled bank. How would things work out? So it tells us a little bit about this kind of counterfactual case that all the regulators are concerned about when we think about bank regulation and bailouts. So we look at collateralized lending. So this is the second largest DeFi application after Dexes. So the numbers change every day, but the last time I looked, it was about $16 billion in this market. So we look at two large lending protocols, Aave and Compound, in our data. So what we show is that there is some fragility in these markets. We show that there's some negative feedback loops. And the way this usually works is that you have these collateralized loans. And if the loans get under collateralized, they get liquidated. And the liquidator then seizes the collateral, sells the collateral on the market, and then the price of that collateral drops. And so this creates some downward price pressure on the collateral. As the collateral decreases in value, more loans get under collateralized, more loans get liquidated, and we see this kind of feedback loop happen. So this has been kind of vaguely shown a little bit in other markets, but here we have very clear data to clearly identify how much of this downward price pressure comes from the sale of this collateral. So I think we can document this in a much clearer way than in traditional financial markets. So let me start a little bit about how does this DeFi lending work. And just let me know if you have any questions at any time, please. So we give some collateral to a lending platform, say Aave. And so in this example, I pledge 11 wrapped ETH and I borrow a Bitcoin for that. So that is fine as long as the value of that collateral is greater than the loan. So we have to use a collateral factor. It's very often 1.2 or something like this. So we have to post 20% more collateral than the loan amount. So in a way, this is similar to some traditional financial markets. If you think about the repo market, that works like that, or a margin account, if you want to trade stocks on margin, that works in a pretty similar way. Yes?
So in traditional finance, how you come out with the 1.2?
Yeah, that's a good question. So that's a governance decision very often. So the token holders of these lending platforms, they have governance tokens. And so what that gives you is essentially a vote. And then they can vote on what the right collateralization amount is. And it's another interesting project we want to look into. How do these factors actually get set? Because this can, as you could imagine very easily, if you have competing platforms, this could be a downward spiral where platforms set lower and lower collateralization ratios to get market share that makes them more fragile. And on the other hand, these votes might not turn out to be very informed or very sophisticated, right? So at the moment, it's pretty naive. Most platforms at 1.2, except for very stable assets as stable coins, then very often the collateralization factor is lower than that. But yeah, I'm sure this is not set optimally. And so that is another interesting thing to look into. Okay, so what happens if this loan is under collateralized? So if the value of that collateral is not enough, is below 1.2. It's still greater than the loan amount, right? But it's less than 20% over collateralized. So then a liquidator comes in, and that liquidator can be anybody on the internet who just runs this, and the liquidator repays the loan and obtains the collateral. So what if the liquidator doesn't have a Bitcoin to repay the loan? To repay the loan, you need a Bitcoin, right? So the liquidator could go to what's called a flash lender, and a flash lender allows you to borrow arbitrarily large amounts for an instant of time. So how does this work? So this is uncollateralized. How can you do uncollateralized lending in DeFi? You put everything together in one transaction. So if you transaction in Ethereum can execute only as a whole or not at all. So that's what we call atomistic transactions. So what happens if I borrow at the beginning of the transaction and repay at the end of the transaction, the borrow and the repay are linked. So either I borrow and I repay so that the whole transaction executes, or I don't borrow and then I don't repay. That's if the transaction fails, right? So these are the only two possible outcomes. So therefore, the flash lender can give money without risk and without collateral, but then the constraint is that you can only do this for an instant of time. So you borrow a Bitcoin, repay the loan, and then the liquidator seizes the collateral, gets the 11 Bitcoin. Now the liquidator has to repay the flash lenders. So how does that work? So you go to a decentralized exchange and swap the collateral for the Bitcoin that you need to return to the lender. And all of this happens in one transaction. And so this is very nice because in a way, this opens up, this is very nice for a couple of reasons. So first of all, you get assured execution. So you get kind of bundled execution. So in traditional financial markets, you have a concern if you would try this and all of a sudden you want to trade here, then the price on your trade might be different and that might cause you to make a loss, right? So since we execute this all in one shot, it only executes if it's profitable. So that in a sense gives you an option-like payoff here because that only works if you really make money from that. So the liquidator can usually keep some kind of profit out of this. And so in my example here, the liquidator keeps one wrapped ETH as profit. So what is missing in this example is that there might be fees along the way. So you might have to pay some fees on the Dex. You might have to pay some fees for the flash lender. So flash loan fees usually are below 0.3%. So Uniswap charges you 0.3. Other flash loan providers charge you less than that. So the YDX, for example, costs you almost nothing.
Do you need to pay to the lending protocol something, or when you do the
No.
Just like network fee for the miners to execute?
To the miners to execute the transaction, yes. So what is also interesting here, in a sense, is that the lending platform is not really involved in any way. So if you think about margin lending here, so then the broker is the one who liquidates your portfolio, right? If you think about traditional bank loans, it's the bank that liquidates your loan or initiates the liquidation. So here, the lending platform stays out of this. They just outsource more or less the enforcement to the general public. And so anybody who can come in here liquidates that loan. So this paper is still pretty much work in progress. And one thing that we want to look at is kind of this, build a little theory model around this trade-off. So obviously the liquidator here has very different incentives than a bank would or a broker would when they internalize some part of these fire sale externalities that we are talking about. Okay, so this is a free for all. So here's one example of how this works. So May 12, 2022, you see here what's called the health factor in green. So the health factor shows you, and that goes on the left axis. What the health factor shows you is kind of how much you are away from that liquidation threshold, and it's normalized to 1. So whenever you hit 1, that means you're not collateralized enough, and then your loan gets liquidated. And so what happens here is that it almost hits 1 here, and then it hits 1 here, and immediately the loan gets liquidated. And so the loan gets partially liquidated here. So some of the collateral goes down, the debt goes down. So the liquidator seizes the collateral, repays the debt, and then the health factor as a result jumps up again. So, but this is very quick. And so there are spots out there that that watch these loans, monitor these loans, and then try to liquidate them as soon as they get under collateralized. So just for anybody who's kind of interested on the technical side, this is not at all trivial because it's not kind of posted anywhere what the health factor of this loan is. So you have to keep track as a liquidator of what has this wallet address borrowed, what's that wallet's address collateral, how much is that collateral worth. And then if you think that the loan is under collateralized, you can make a liquidation call. And if you make a liquidation call, then the AWE computes, oh, is this loan really under collateralized? Let me figure this out. And then they find out yes or no, and then you can go ahead and liquidate the loan or not. So this is not a trivial thing. You have to actually invest quite a lot of computing power and skill into finding these under collateralized loans.
This is the reason why we don't see at the first time when it hits 1.
So this is slightly above 1, interestingly. So it didn't really hit 1 here. So this is slightly above, and it doesn't come out very nicely in the graph. I should redo that. So it doesn't really hit 1 here, but it hits 1 here. So the second time around. But then that is instant. Then it's pretty much instant, so yeah.
But there is not, it's not trivial that there needs to be a lot of computation power going on, but then we still see the instant.
Yeah. Yeah, we still see that very fast. So there's a lot of people who keep track. So you need to run more or less a node and keep track of who is holding what positions on the blockchain. You have to figure out what is all the value of the collateral at any time and track everybody's loan. So on these lending platforms to figure out who is underwater. So. Okay, what we want to show you so far is we want to show that these liquidators often sell the collateral immediately on a DEX, and then this has a lasting price impact. So for us, this was not totally obvious. This was a little bit surprising because if you think about this, this is not really that any new information gets produced. So we would think this was a noise trade, right? So if a loan gets liquidated, then just Bob happens to have not enough collateral. What can we learn about the world from this? But it seems that this has a lasting price impact. There's this has a lasting price impact on the exchange where the liquidation happens, but also has implications for other exchanges. So the oracles update when every exchange now has a lower price. So then the oracles update on the blockchain. And that means more loans get under collateralized. And we see this liquidation wave unfold. And so what we want to show is what kind of general implications does this have on the distribution of token returns. So we look at data from Aave and Compound. So from September 2018 to May 22, so we look at 42,000 liquidations. We have 37 collateral tokens, 41 debt tokens. So total liquidations are about $2 billion. The average liquidation is pretty small, so 64,000. The median is 3,500. So these are not all big ones. There's quite a lot of heterogeneity. The largest single loan liquidation was $50 million. And so there's a lot of heterogeneity in these kind of loan liquidations. We also look at all the trades on decentralized exchanges. So we look at all the Uniswap and its clones, Uniswap clones. So we collect data from 8 different decentralized exchanges to track prices. So let me show you a little bit what the most popular token pairs are. So as collateral, we often see ETH or Bitcoin showing up here and the Chainlink token, versus as a debt token, we often see some stable coins. And so the idea behind this seems to be consistent, at least with levered trading. So people who are bullish on Ether buy ETH, deposit that as collateral, borrow dollars to buy more ETH. So we have this levered margin trading. Seems to be a most prominent application for this. There you can see here there is about $500 million in liquidation in the ETH USDC market. So you probably all know this, and I'll just bring this up so in case there are any questions. So how do decentralized exchanges work? So we can track price impact. So a decentralized exchange, it consists of a pool of 2 tokens. So we have a token and say ETH here, and you bring in some inventory, T0 and E0. And so you are on this point of this bonding curve. And so the bonding curve is given, it's a mathematical formula, just says that the product of E and T is a constant. And so what happens then if somebody sells some tokens, what happens is that the supply of tokens in the liquidity pool increases. And so to figure out how much ETH you get back in return, you do this graphically. You go with the increased inventory of tokens to the curve and to this side, and you see how much ETH gets paid out. So because we have all this information on chain, we can directly compute price impact. We can compute how much do these liquidators get, what is the new price of the decentralized exchange. So here is pretty much what we are going to do in the paper in one picture. So this is a wave of about 180 liquidations of the Link token. So what you see in gray here is the amount of tokens, that collateral that was liquidated. So we see that this kind of starts out slow, and then you see this huge wave that unfolds here. What we see in the colored lines are the prices. So most liquidations in this picture happened actually on sushi swaps, which is the blue line, but Uniswap is the orange line. And so we see that as this liquidation wave unfolds, the price of the collateral drops quite a bit. And then it stays low for a while afterwards as well. So this has price impact. when we sell the collateral, and that triggers more and more loans to get liquidated. So in the red line, what we see here is we filter out all the trades from these loan liquidators. And then we can do we can look at what would happen to the price of the token if only these loan liquidators would have traded on the DEX and nobody else would have traded. So we see that that tells us a little bit about how much of this price impact is directly attributable to these loan liquidations. And what we see here is that a lot of that initial drop here that we see can be directly attributed to these liquidators of the loan. So that tells you a little bit that these loan liquidations have a huge price impact. So it's not that we learned something at the same time. It was not that we learned something new about the link token coincidentally at this time that drove the prices down. It was really that a lot of this price drop comes from the collateral sales. Actually, if it was just up for the loan liquidators, the price would have dropped much more. What happened is that somebody else was buying at some point, so the price didn't fall as much. In terms of contagion, what we can see is that most of the liquidations happen on SushiSwap, but we also see a price drop on Uniswap, which is the orange line. So there is contagion to other exchanges. And what's more interesting is that the green line shows you the price on Binance. So there is contagion to Binance. Now, Binance is completely off-chain. It doesn't have anything to do with collateral, loan liquidations. So none of this collateral was sold on Binance. But we still see that the Binance price drops a lot. So we have contagion off-chain. So why is this interesting? First of all, if you ever think about tokenizing stocks or other financial assets on bringing them to DeFi, we can see here that these liquidations that happen on DeFi can cause contagion on traditional financial markets. So what could happen if we tokenize stocks and bring them as collateral to Aave or Compound or some other platform like this, we could see contagion to the real stock market coming back here. And second, a lot of people tend to think that price discovery only works on the centralized exchanges. A lot of people think that price discovery happens on Binance and then DeFi just tags along and adjusts, right? But this is clearly an event that emanated in DeFi. And we see that price discovery also happens in DeFi and then spills over to Binance. So it is not totally true that DeFi is stupid and no price discovery happens on DeFi. So this is not at all true. This is a nice counterexample to that. Yeah.
So basically, the idea is that the liquidation trigger swaps in the DEX because people want to exchange the token due to the liquidation. So these kind of have the strong effect on the token regardless of other traders. It's not that other traders kind of thinking that the token be worse. Just like this big liquidation is pretty much.
I mean, we don't really know what other traders seem to think, but we know that the other traders in aggregate must be buying, right? Because the liquidators, if it is only to the liquidators, we would be on the red line. So if the other traders would also sell, then we would see the aggregate price being even below that. But it seems that the other traders are buying. So seems that most of this, the net effect seems to be caused by the liquidations.
We understand the whole movement from, let's say, what is
Yeah, I think that's due to arbitrage bots that see a price difference.
But then for the Binance, we couldn't expect them to be the same arbitrage.
But I think there's arbitrage bots between Binance and DeFi too. And it's a little bit more complicated and capital intensive, right? Because obviously you need to hold capital on Binance. and capital on DeFi, but then you can still arbitrage, but you have to hold kind of it's more capital intensive. If you're a poor DeFi arbitrage bot, you can use a flash loan to arbitrage the price difference between Uniswap and SushiSwap or something like this. Okay, so just to give you an idea that this is not an isolated instance. So this shows you that the blue line here shows you the liquidation waves, and the red line shows you the price of ETH. So very often these liquidation waves coincide with a price drop in ETH, in part because this is the largest market, is this, as I showed you before, is this margin trading, right? And so then we see that when people buy ETH on margin, then obviously if there's a huge if the price of ETH drops, there's a huge liquidation wave. But there's also liquidation waves that happen without the huge price drop in ETH. So, so to show you that these have some kind of price impact, these liquidations, here is an example where somebody liquidated $20 million of wrapped Bitcoin collateral. And so this shows really kind of the very detailed block by block data. So you can see here that these are prices on 3 different exchanges: SushiSwap, Uniswap, and DeFi Swap. And so the liquidation happened on SushiSwap, as you can tell. So the liquidator liquidated the collateral on SushiSwap. So the price on SushiSwap dropped. And then some bot figured out, hey, there's a huge price difference now between those dexes. So let's do some arbitrage. So you can see that here, the bots bought on SushiSwap and then sold on Uniswap and DeFi Swap and who knows where else. So we see that the prices then converge over time. There's always a little bit of a price difference, partly because an arbitrage the profit from the arbitrage has to exceed the transaction costs. And so if gas fees are high, then it's not really worthwhile to do that. So we'll always see a little bit of a price divergence. But what we found interesting is that the price was quite a bit lower after that liquidation, and that lasted for a while. So that lasted here, the picture is for about half an hour. And that's long enough for all the oracles to update. So now all the pricing oracles and DeFi say, oh, Bitcoin has decreased in value. And so obviously now a lot of loans are reevaluated and it's being figured out if they are adequately collateralized or not. Yeah. Sorry.
So why do you think so the guy that did the liquidation is kind of saying that it's either that he's only specialized on liquidation, because you need to be aware that he's going to create a arbitrage opportunity. So why is not kind of doing it in the same time?
Yes, that's a very good question. So I think this is a very specialized business. You have to be it's really competitive to be a liquidator. You have to be really on time. So I think people just specialize in one thing and say, I know that there's money left on the table after my loan liquidation, but I'll just leave that money for somebody else to jump in, because it's really competitive, and you probably don't want to risk. The other problem is that you have some execution risk, right? So suppose you want to trade on 2 different dexes at the same time, you probably impose some limit price on these orders, and then what if that one trade falls through or something? So this just makes sure that you get your liquidation profit and you're done. So to show you that they have a little bit of a price impact, these liquidations. So here we look at the 5-block return. So 5 blocks is enough so that the pricing oracles update. So a block takes about 15 seconds on Ethereum. So here we look at the short-term returns, because what we also don't want to mess up that there could be many liquidations happening afterwards. So what we look here is, does the return of the liquidating swap explain the 5-block return? And 5 blocks is also long enough so that the arbitrage bots can kick in and bring the price back up. So if somebody thinks this price is out of whack, it is not really the fundamental price, somebody could react in 5 blocks. And so we kind of should see that people adjust if they think this is not true. So what we do see is that the return of that liquidating swap has a price impact on the DEX where the liquidation occurred. And it also has a price impact on other exchanges within those 5 blocks. So that's evidence clearly that these arbitrage bots kick in within those 5 blocks. And so we do see contagion on the liquidated DEX, other DEXs. So that's enough for these oracles to update and reevaluate other nodes. So we also control for a bunch of other factors. If you have any other interesting ideas, let me know what we should look for. So the next thing we want to look at is a longer term perspective. So we have these liquidation waves. We want to look at what happens before the liquidation wave. And then the liquidation wave, we compress here into time 0. And then we look at what happens after the liquidation wave is over. So obviously, there's a huge drop in the token price in the liquidation wave, which is not what we want to show too much in the picture. So the blue line is the average, and the orange part are the kind of 90% or 75% confidence interval around that. So what you see is that the price impact drops before, the price drops before the liquidation wave. And then there is a discrete jump, and then it kind of stays low after the liquidation wave. So there is a real kind of a real term price impact here that lasts for a while. So that was for us surprising. Maybe we talked to a few people said, well, that's totally obvious that there will be a permanent price impact. For us, it was not, because we thought this is not really have any new fundamental information about the value of the token. So we want to look at, so in the next regression, we look at the returns throughout the wave. And so we look here at multiple liquidations versus single liquidations. So this is not really a wave. This is just one liquidation that happens, and then multiple liquidations. So first we look at the return of these liquidating swaps. And we find that in the single liquidation case, these are not important. So if there's a single liquidation, then it has no permanent price impact. But if there is multiple liquidations, then these liquidating swaps really contribute a lot to the long-term price impact of the impact on the price after the liquidation wave. So we look at the wave size and the wavelength and the gas price. None of these really matter that much in our sample that we find. Mm-hmm.
The multiple liquidations are very different from the single one because there's already selection.
Yeah, right. And so in the multiple liquidations, the price movements are bigger, right? So then
I just wonder if you could do like single liquidations, like what happens if there happens to be a second one.
Mm-hmm.
Like not.
Yeah. So it also depends on the size of the liquidation, right? So I mean, if you have 2 liquidations for $500, it will not make a difference. If you have one for 50 million, it will make a larger difference.
Right. So I guess I'm saying that look at, like, for example, one single liquidation that's $1,000 versus multiple, like 2 liquidations that are 500.
Okay, yeah, that's a good point. Yeah. Okay. Yeah, that's a good point. We can definitely try that. That is actually very nice. Okay. So these liquidations do have some price impact, and we see that in the token distribution. So here we look at 5-minute returns. And again, we pick something fairly short because we want to isolate the effect of the liquidation itself. We want to get, so the price probably of that collateral token starts decreasing. So that's to trigger this liquidation wave in the first, to trigger this liquidation wave. And we want to get events where the price was going down and there was no liquidation, and where the price was going down, but there was a liquidation in those 5 minutes. So this is why we choose 5-minute returns, so that we have on the same day, which was probably a bad day for that token, where we have returns where there was a liquidation and returns where there was no liquidation. And so what you see is that a lot of these fat tails that we often talk about in finance come from these loan liquidations. So these loan liquidations cause a lot of very extreme returns. And this is interesting because it creates this externality for investors in the token. So if you just hold the token and you're not at all into lending or DeFi lending at all, but now you are exposed to greater risk because this token serves as collateral in the DeFi market. So that has potentially some interesting implications in the finance market as well, where we do have that these stocks serve as collateral for margin trading or for other activities. And so in finance, we also observe these kind of fat tails in stock returns or other asset returns in traditional financial markets. And it's always kind of, where do these fat returns come from? So this is one potential source where these fat tails could come from. So let me talk a little bit about these liquidators. What do they do? So we have about 1,000 different liquidators. We can only see liquidator wallet addresses. So it could be that these are just 2 people having 500 wallet addresses each. Unlikely, but it could be that the actual number of liquidators is smaller than 1,000. Okay, so liquidations are very concentrated. So the top 20 liquidators perform about half of the liquidations and liquidate 75% of the collateral. So a top liquidator liquidated over almost like $430 million. So here's how this picture looks like for the top 20 liquidators. So we have here the liquidated amount in $1 million, and blue is Aave and orange is Compound. So 2 takeaways. First of all, this is really very concentrated. So the top liquidator is really has a huge market share. So that is probably the best and fastest bot. So that shows you that technology is very important in this space, where you have to have the technological edge to be the first one in to liquidate the loan. So there's fierce competition for this. The second thing is that specialization pays off. A lot of these liquidators are specialized. They only do Aave or Compound. Now, it could be that the same person runs 2 separate liquidators. Still, it's not optimal to do that. Why? Because a lot of these loans do have some capital. So if you liquidate a small amount, a small loan, then you don't want to pay the fees for a flash loan. If you remember in the first picture that I showed you, I showed that, yes, you can overcome capital constraints with a flash loan, but for $1,000 liquidation, that's probably not necessary, not really worthwhile to pay the fee. So all these bots have some capital, and they don't always use flash loans. And so they use flash loans mostly for the very large liquidations. And so from capital efficiency, it's better if one wallet address does both chains, because then you can deploy that capital that you have more efficiently. So, but still, it seems that there's gains from specialization, just because the tech is really hard to do.
Do you observe if some of these addresses are related to miners? Because we know from sandwich attack that many times the address is related to miners.
So very often these, I still need to do this, but very often a lot of these loan liquidations go through flash bots or some similar interface, right? So in flash bots, you can go to the miner and say, look, I found this liquidation opportunity. I will make $1,000 profit from this. How about I give you $800, and you put my transaction at the beginning of the block. And so that happens. So for sure. I mean, this is not, to compute the liquidator profit is really hard, because we have to think about how much do they pay to the miners. And as a side note, to figure out these payments to the miners from flash bots is not trivial at all, because they don't get paid as regular fees, they get paid as private transactions. It's really a side payment to the miner that very often doesn't show up in a lot of the traditional data providers like Dune or something. So to collect these side payments, we run our own archive node and replay the whole blockchain to really collect these side payments. So it's a non-trivial thing. Okay. So when are swaps being used as collateral? So what's the strategy that these liquidators follow? So we can think about, when do they use swaps? They use swaps when the collateral is very big. So if it's a large liquidation. And that makes sense, because these liquidators don't want to be exposed to price risk, right? So you could take the collateral on your own book, but then you would have the price risk that this collateral depreciates further in value. So if you swap it immediately, you get rid of that price risk. And so for large loans, they use a swap. So it correlates with the size of the wave. So if the wave is larger and shorter, then more swaps are being used. But here it's hard to say what the causality is. Maybe the wave is large and short because people swap, and then the price goes down because of the swap. And so this is why the wave gets larger and also evolves more rapidly. Or it could be that when the wave is large and fast, then you want to get out of the collateral very quickly as a liquidator, and then you swap. So it's very hard to say what the causality is, but we can see at least this interesting correlation here. The gas price and liquidator size seem not to be important, in part because flash loans can overcome any capital constraints. The last thing we are looking into is any predatory behavior by these liquidators. So you can imagine that this is not a very nice world, right? So Ethereum is a dark forest, we all know that. And so what happens is that these liquidators could see, if they see a loan that's at the brink of default, they could push the loan a little bit by pushing down the price. And so then they push the loan into default, and then as the loan defaults, they collect some money from this liquidation. So we don't have we haven't systematically looked at this, but I can show you one case study. So in May 21, we had about 147 loans with wrapped Bitcoin as the collateral were liquidated. So this is about $64 million. And we look at what do these liquidators do before the liquidation wave happens. So, so here is the same picture. You see these loans being liquidated, starting here at time 0. That's when the liquidation wave starts. So this is the time in blocks. And what you see here is the price of the collateral in orange. And what is new here is that the position of these liquidators in blue. So what they see is that these liquidators, before the liquidation wave starts, they were moving out or selling these Bitcoin. So coincidentally, at this time, the price of Bitcoin goes down. So there's some evidence. I don't know, there's of course no proof, but at least the evidence is consistent with the idea that as a liquidator, you see that there's a bunch of loans that are close to liquidation, and then you just short the collateral, and then you see the price is dropping, and then you can start liquidating these loans. So what happens as this liquidation wave starts unfolding here a little bit, they don't buy those liquidators. They keep selling and selling until the whole liquidation wave unfolds, and we see the price of the collateral drop massively. So then, interestingly, those liquidators start buying. So it's not totally obvious how this works, but at least the liquidators seem to be less innocent. So they're not just simple bystanders waiting for a loan to be liquidated. They seem to take active positions in the token. Yeah.
Wouldn't this be risky? Like, suppose we have dogs that found out they're short this asset, but then if you're not able to actually push it over the edge, then the short behavior becomes constant.
Yes. But we have here very asymmetric return distribution, right? So if you think of a traditional return distribution, it looks like this, right? So what you have here in this situation is, well, either it looks like this, or we have this huge liquidation wave, which looks like this. So if you see it here, I mean, there's huge potential gain on this side. So, and if you know all the blockchain data, if you can read that, you're aware of this. Other people might not be aware of this because they don't know. Okay, so to conclude, so we showed that these decentralized financial markets are inherently fragile. So there's, I hope to convince you that these negative feedback loops exist in the market, and we can have some really nice evidence of the micro foundations of these feedback loops that we could not get in traditional financial markets with traditional data. So this market, or the way this market works, affects the return distribution of the assets, and that causes some externality for the other token holders. So I think this is interesting for market regulators when the other markets like repo and things like that move to a system like this, but even also to understand how would the repo market do if there was no government intervention, how would things work out there. So I think we're the first paper to document some kind of systemic risk in this decentralized market.